If you were born in 1940, you had a 90% chance of earning more than your parents did at the same age. If you were born in the 1980s, that number dropped to 50. A coin flip. The economy is 4 times richer than it was in 1989, and somehow you have less money. So today I'm breaking down the exact mechanical reasons why, one by one. Starting with the number that explains everything, the wealth gap. Here's a stat that should make you uncomfortable. Millennials at age 40 have a net worth of around $91,000. Baby boomers at the same age? $113,000. That's roughly 20% less wealth despite the overall economy being massively richer than when boomers were building their lives. Total US family wealth has nearly quadrupled since 1989, climbing to $199 trillion, but millennials hold only 4.6% of it. Boomers, 53.2%. The pie got enormous, your slice got smaller. Now here's the thing, you probably already feel this. 72% of Americans say young adults today have a harder time saving for the future than their parents did. 70% say buying a home is harder. This isn't delusion. The data backs up exactly what people experience every single month when they look at their bank accounts. But the distinction that matters most is one nobody explains properly: income versus wealth. Younger generations might earn slightly more in raw dollars. Cool. But wealth is assets minus debts, and when you subtract student loans, sky-high mortgages, and non-existent pensions from modest savings, the balance sheet is worse at equivalent ages. You're not imagining it. The math is just broken. But the real question is, why? And it starts with the fact that your paycheck stopped keeping up with reality a long time ago. Wage stagnation. Here's the thing. Nobody tells you when you enter the workforce. The deal changed before you were born. From the end of World War II through the early 1970s, there was an unspoken contract. You work harder, you produce more, you get paid more. Productivity went up, wages went up, simple. Your grandparents lived in that world. Then something broke. Since 1979, net productivity in the United States has grown by more than 90%. Hourly compensation for typical workers, it rose by about a third. That means productivity grew roughly 2.7 times as much as pay. The money didn't disappear, it just stopped reaching the median worker, and this isn't some vague feeling. You can literally watch 2 lines on a graph move together for decades, then split apart like a zipper after the late 1970s. One line keeps climbing, the other one flatlines. What caused this? Globalization, automation, the collapse of union membership, corporate obsession with shareholder value, the rise of gig work and contract labor. All of it eroded bargaining power for ordinary workers. Even the gains that do reach workers flow disproportionately to the top, so the shrinking slice gets eaten by people making 6 and 7 figures. Here's what makes this generational. If you entered the workforce after the 1980s, you have never experienced the old deal. You've spent your entire career in a world where producing more doesn't mean earning more. You never had the era where a rising tide actually lifted all boats, you just got the tide. Now, stagnant wages alone might be survivable. Annoying, sure, but manageable. Except costs didn't stay flat, they exploded. And nowhere is that more devastating than where you live, the housing catastrophe. Housing prices have exploded over the past 25 years, and it's crushing younger generations' ability to build wealth. The Case-Shiller National Home Price Index started at 100 in January 2000. By March 2026, it hit roughly 330, meaning average home prices have more than tripled in nominal terms. Meanwhile, median real weekly earnings barely budged during that same stretch. Prices shot through the roof, wages stayed mostly flat. That's the bare-bones math behind the housing catastrophe. Price-to-income ratios soared from about 3 times annual income for previous generations to 5, 6, or even higher in many hot markets today. What used to be a relatively affordable milestone has become a financial Everest. Here's where it gets weird. This spike isn't just raw market forces. Restrictive zoning in the most desirable metro areas has crushed new supply. Instead of adding housing to keep pace with demand, those rules create scarcity, and scarcity means sky-high prices that homebuyers must swallow. Institutional investors have plunged into single-family housing, buying up homes to rent out or hold as investments. Ultra-low interest rates made borrowing cheap, except that cheap credit got baked into home prices, pushing them up further rather than making homes more affordable. So you get a vicious cycle. Existing owners, mostly older generations who bought when ratios were low, pull ahead with massive capital gains. They often vote for policies that block new housing, preserving scarcity and inflating their own wealth. Younger people face much bigger down payments and mortgages relative to their incomes, making them vulnerable to interest rate shocks and shutting them out of wealth building entirely. Walk into any city and you'll see the effects. Skyrocketing rents, endless bidding wars, houses that need a lifetime of income to afford. The housing boom that built older generations' wealth has turned into a barricade for younger ones, but if you think that's bad, wait until we dive into how the student debt trap compounds these financial chains. The student debt trap. Here's the deal with a college degree. In 2026, you need one to earn a living, but getting one might prevent you from ever building wealth. It's the most expensive entry ticket in history, and $1.66 trillion in outstanding student loan balances proves nobody's figured out a better way to pay for it. Let me put that number in human terms. You're 25, you graduated, you landed the job. Congratulations! Your monthly student loan payment is somewhere around $400 to $600. You also want to save for a house, you also want a retirement account before 30, you also have rent, insurance, food, and the general audacity of existing. Something has to give, and it's almost always the saving. About 35% of all student borrowers are Gen Z. 11 million millennials still haven't paid theirs off. The serious delinquency rate just hit 10.3%, meaning $1 in $10 owed is severely past due. Cool, that's going well for everyone. Here's where the trap snaps shut. The college earnings premium still exists. Degree holders earn substantially more than non-degree holders. On average, the math works out. A hardware but, on average, is doing enormous heavy lifting in that sentence. Returns vary wildly by field, by institution, and by whether you actually finish. A nursing degree from a state school, solid investment. A communications degree from a private university that charged you $180,000 coin flip at best. And here's what makes this fundamentally different from your parents' experience. Earlier generations could finance a degree through low-cost public universities and modest savings. The current system requires large personal loans because per-student funding has been gutted. Your parents didn't need to gamble, you do. Every dollar going to loan payments is a dollar that cannot go toward a down payment or retirement. Student debt mechanically delays every wealth-building milestone by years. You're running the same race your parents ran, except someone strapped a $30,000 weight to your back at the starting line. But at least student debt has a theoretical end date. What replaced pensions doesn't? The pension switch. Here's something that might not register if you're under 40. Your grandparents retired on a guaranteed paycheck. Every month, same amount, until they died. Didn't matter what the stock market did. The company promised them a specific income based on their salary and years of service, and the company had to figure out how to pay it. That system is basically extinct in the private sector now. What replaced it is the 401k, which sounds like a retirement plan, but is really just a savings account with tax benefits and a prayer. The fundamental difference is who gets screwed when things go wrong. In the old system, if the market crashed, that was the employer's problem. In a 401k, if the market crashes the year before you retire, that's your problem. Your retirement just evaporated, and nobody owes you a thing. And here's where it gets genuinely insidious. This isn't just a shift in how retirement works. It's a shift in who builds wealth from retirement systems at all. Someone making $200,000 a year maxing out their contributions with an employer match is playing a completely different game than someone making $45,000 who can barely afford to contribute 3%. The behavioral gaps are massive too. Many workers don't contribute enough, panic sell during downturns, or withdraw early. The old pension system avoided all of these problems by design because individuals never had to make those decisions. The numbers tell this story. Between 1989 and 2022, the top 10% of families increased their wealth share from 56 to 60%. The top 1% went from 23 to 27%. A retirement system that rewards people who already have money is going to concentrate wealth further, which is, exactly what happened. Most people under 40 have never known anything different, so the 401k feels normal. It's not normal. It's an enormous experiment in making individuals absorb financial uncertainty that institutions used to handle. And if you think invisible risk transfer only applies to retirement, wait until you see what's happened to the cost of literally everything else. The cost of everything else. Here's where all of this stops being abstract and starts being your actual bank account on the 15th of every month. Healthcare spending as a share of GDP has roughly doubled over the past half century. That's not just a number on a government chart. That's your premium going up every year while your employer quietly shifts you onto a high deductible plan and calls it consumer choice. Medical debt is still one of the leading causes of bankruptcy in the country. Not gambling debt, not credit card debt from buying stupid things, medical debt. From the crime of getting sick, then there's childcare. In most major metro areas, full-time infant care costs as much as rent, sometimes more. Two-earner households, which is basically a requirement now, often find that one parent's entire take-home pay disappears into daycare. For single parents, it's just impossible math. But here's the thing. Nobody frames correctly. It's not that any one of these costs is uniquely devastating, it's that they all hit at the same time. A 30-year-old couple in 2025 is simultaneously servicing student loans, paying rent that would have bought a house in 1995, covering childcare that costs more than their car payment, and watching healthcare premiums climb every year. On wages that have barely moved in real terms since their parents were their age, there is no margin left. Zero. Every dollar is spoken for before it arrives. An unexpected $400 expense, a single missed paycheck, and the whole thing collapses. That's not financial irresponsibility, that's structural. And here's the distributional kicker. Higher income households absorb all of this easily. They max out tax-advantaged accounts, benefit from employer contributions, get the childcare credits that actually matter at their bracket. Meanwhile, lower and middle income households watch their saving capacity get destroyed month by month. Not slowly, completely. Your parents at your age weren't juggling all of these inflated costs simultaneously on a wage that hasn't kept pace with any of them. They had breathing room. You have a spreadsheet that ends in red every month no matter how many times you rework it. But if you think this squeeze is just bad luck or bad timing, wait until you see the structural machinery that was built to produce exactly this outcome. The structural reason. Here's the thing. The decline in upward economic mobility isn't because our economy stopped growing. The pie has actually gotten bigger. The problem is how that pie gets sliced. It's not some mysterious force holding back younger generations, it's a fully predictable result of policy choices that reshaped who gains from growth. Labor deregulation suppressed wages even as profits and GDP rose. Zoning laws constrained housing supply in high-demand areas, pushing prices sky-high and locking out new buyers. Federal student loan programs replaced direct public funding of education, inflating tuition because universities knew loans would cover the cost. The tax code started favoring capital gains over earned income. And pension law changes enabled the shift from defined benefit plans to 401ks, transferring risk from employers to individuals. So who actually benefits? Existing homeowners who see their asset values climb thanks to scarcity. High earners who exploit tax advantages that disproportionately reward capital income. Universities which raise tuition because loans keep students enrolling no matter the cost. Employers who shed expensive pension liabilities onto workers while keeping paycheck growth slow. Everyone is reacting rationally to the incentives, but the combined effect disadvantages younger generations dramatically. This isn't some freak accident, it's path dependent. Older cohorts built wealth under one set of rules, rising home equity, stable pensions, slower tuition inflation, and then policies shifted to lock in their gains while raising barriers for the next generation. Meanwhile, younger people face higher buying costs, greater debt burdens, and more financial risk. What does it take to reverse all this? It's not just about growing the overall economy faster, it requires changing how growth is distributed. That means pushing for broad-based wage growth instead of stagnant paychecks. Expanding housing supply to lower prices rather than hoarding scarcity rents. Rebalancing education funding away from loans toward public subsidies, and rebuilding collective risk-sharing systems that don't dump retirement and healthcare risks on individuals. The fading of the American dream comes down less to slower GDP growth and more to unequal distribution of that growth. Younger generations aren't poorer because the economy shrunk. They're poorer because the game was rigged to protect legacy wealth. Now you understand the machine. If you enjoyed this video and want to see more, click the video on the screen now.